Hi. Welcome to the wrap-up session for class 3. This is to notify you that this meeting is going to be recorded and it's going to be broadcasted live on YouTube. Hi. Welcome to the wrap-up session for class 3. So your decision to stick around and join this meeting shows that you've already accepted that this meeting is being recorded and broadcasted live on YouTube. So thank you and welcome. Let's give the rest of the crew about a minute or two to join in. Okay. So at exactly 3 minutes after 8, we're going to start. All right. Welcome, guys. So, how has your day been? I hope it's been a beautiful weekend for you so far. Yes, I know for those of us who are into stocks, the week was a bumpy ride. Not only was the week a very bumpy ride, there was a lot of sell-off, even in the crypto market as well. But I'm happy we're here. We didn't die, as some people will say. Happy we no die. Now, I'm sure that in the last couple of weeks, that I have set up this meeting and we've had the classes, we've been able to go through 8 modules, beginning with learning the basics of personal finance, which included budgeting, emergency fund, getting a net positive cash flow, and deciding what amount of money that should be invested. This, no doubt, has given all of us a better foundation to investing in stocks. It was broken down in stages where an investment plan was considered. We also went ahead to consider what is the risk profile of each person. It's a personal thing. The investing is a personal journey. You don't necessarily have to invest like your brother, like me, or like your colleagues. Everyone has different risk profile. And we already went through that when I sent us link to take the risk profile test. It was after the risk profile test that I created the model portfolio. And as I said, the model portfolio wasn't something for you to follow hook, line, and sinker, but it was a guide. And if you choose to follow it, it's all well and good. But it was meant to be a guide for you to study it and understand why a particular portfolio fit into the conservative risk category, why a particular portfolio fit into the moderate portfolio or the aggressive portfolio. We also had moderate, aggressive, and moderate conservative. And I know as we went along, many of us felt we are aggressive in nature. And I'm sure if you felt you were supposed to be in the aggressive category, because an aggressive portfolio has the potential to grow faster, but there's a two sides of the coin. The price for growth is volatility. The portfolio that has the potential to grow very fast also has the potential to have a very strong drawdown during market volatility. So I'm very sure that anyone who isn't really very aggressive in nature and who isn't very conversant or comfortable at an aggressive portfolio, who then went ahead to choose an aggressive portfolio, would have had to learn a hard lesson during the sell-off, witnessing a huge drawdown to their portfolio. And this drawdown is what an aggressive portfolio does. And someone who has a very high risk appetite wouldn't bother. The person will be patient. Please kindly switch off your video. The person will be patient enough to be able to go through the drawdown and wait for the market to recover and go on. So I'm going to appeal to you. Do not, because you want your portfolio to grow very fast, pick one that does not fit your risk appetite. Usually, I must say, many new investors who are new to the market are better off starting with a conservative portfolio or a moderate portfolio. The more comfortable and the more your conviction about the market grows, then you can move on to become an aggressive investor. I started off as a very conservative investor, but right now I'm moving from the moderate aggressive to the aggressive. So it's a journey. I remember that after we went through setting up our investment plan, checking the foundation of a good financial plan, we did the risk profile analysis. I created for us the model portfolios based on different risk profile. Then I asked us to choose the broker we were to use. So everyone went on to choose a broker. For those in Nigeria, we were able to choose from some of the popular brokers that we have. And for those of us joining from other countries, we were able to research the broker in our local territory, and we picked these brokers and we started investing. I remember saying to us that there's a theoretical part of the class and there's a practical part of the class. Yes, I know. Many people kept on feeling that they needed to learn all there is to know before making their first investment. In the preceding session that I had with the batch A, who came in at 6 p.m., two people made a comment that they were waiting to invest later after learning all there is to learn. They missed out on the opportunity of being able to experience emotionally how one can respond when there is a drawdown in the market. A drawdown is an opportunity to learn. It's an opportunity to buy the dip, as it were, and an opportunity to grow. No one in a class situation will really be able to tell effectively how he or she will behave when the market is experiencing a sell-off or a dip. No one knows. It's only when you have invested your money in the market and then there is a sell-off, that's when you can really say how you will respond in practical case. So if you have not invested at all, you have missed the opportunity to learn during the market dip. It's an opportunity to learn. And at a later time, I'm going to ask us to share with the rest of the audience the lessons we learned if we really did invested during the drawdown that happened in the market. One of the key models that I taught during the session, during this course, was The psychology of a great retail investor. I did mention 4 traits, 4 emotions that come into play when you're in the market. The first one is greed. The second one is fear. The third one is impatience. And the last one is ignorance. I explained very carefully and in detail how fear, greed, impatience, and ignorance can ruin our investment and lead us to so much losses. These 4 things are a far greater risk than volatility in itself. If you can manage this emotion, which is the greed, the fear, and the impatience, if you can manage them effectively, you are going to grow up to be a very great investor, managing your fund yourself. Already the ignorant part is being handled by you attending this course and learning the basics. Because with more knowledge, you can make a more better informed decision. But ignorance can lead to so much losses. For example, not understanding how to manage greed in the market can cause someone who is supposed to buy a low-cost index fund to buy an individual stocks with a high beta and a very high volatility, hoping to be able to jump in while the stock is low and jump out when the stock is high in order to sell within the day or within a couple of days and recoup huge gains. That is greed. Because it's possible for you to get in at a low price at the point, and the low price can then go even lower. And when a low price goes lower, the potential for that quick profit is not realized. And greed gravitates into fear. And the person becomes so afraid that it's possible that this particular stock that he or she at one time thought was low has gone lower and is going to crater even more and probably go to zero. And then greed moves to fear. And then the person sells off. The greed also may have caused the person not to do due diligence about the company, because it is due diligence you do about a company that helps you to develop a strong conviction, not just in the price of the stock, but in the business. Because listed companies in the stock market have underlying companies that have businesses with real customers. So buying the stock is saying, I love this company, I admire this company, and I'm sure that this company is going to keep growing. And so I want to buy shares in this company and be able to benefit from the growth that will happen to the company. Because over time, the growth to a company's business translates to growth in the appreciation of their stock price over time. In the short term, the up and down movement of the price of stocks are determined by the forces of demand and supply. Demand for a company's stocks sometimes come about by people who are interested in the business. But there is a second group of people that are responsible for the movement of price of stocks up and down. They are speculators. People who want to buy low and sell high. So they speculate, and in the short time, they drive the price of a stock up and down. But they can't do this forever, because sooner or later, a good business will have real customers that like the business coming into the business, buying the stock of that business and holding it for 2, 3, 5 years. And the more the company continues to get profits and grow, the more people will join in buying the stock and the price will go up. So if you do not manage your greed effectively, you will be playing a short-term game. But if you like the business, or if you buy low-cost ETF All you have to do is every month have an allocation. You buy. When you buy the shares every month, using dollar cost averaging, over time, you can grow your portfolio and enjoy the growth and yield that comes from owning stocks. Fear. I remember saying that fear leads people to sell off their stocks and lose confidence in the ability of the stock market to recover during a drawdown. So it's possible last week, some people have sold off their stocks. Now, that is even more risky because they are now going to lose out on the momentum that is going to come after the stock market recovers from this sell-off. Perhaps it's going to recover next week, maybe in 2 weeks' time, maybe a month time. But the stock market has an history of always recovering. It's not going to stay down forever. And impatience causes people to sell off without waiting for a great company to recover in their price. In fact, many times when the price of a stock goes down, if the business is good, the business is not experiencing any form of maybe crime or fraud, it's not as if they are going into bankruptcy. The business itself is still strong and it's still profitable, but the price of the stock is going down. That is a sign that that business is selling at a discount. It's an opportunity for you to buy. So contrary to what many people do and think, they go ahead and sell off and lock in their loss instead of them to buy more. By the time the market recovers, a lot of people who bought when the market is low or who held on to their position are going to smile at the end of the day. And I remember concluding the class by telling us that a reader, an investor who learns will keep growing and will keep doing better. And I shared with us 10 books that we can read. Number one among the book is The Psychology of Money by Morgan Housel. I hope we got the book and I hope we read it. And that's the summary of the entire class. So now I want to open the floor for us to ask questions. So it's time for us to ask questions. So do use the raising your hand feature if you want to ask questions so that I can attend to our questions before we wrap it up for the day. You can either use the chat function to send in your question, or you raise your hand and then I'll call you. Adeola, Emeka, Fortis, and Umo. Do you have questions you want us to treat? All right, Imo, go ahead.
Okay, good evening, everyone.
Good evening, welcome.
All right, it seems you can hear me. Yes, so first of all, thank you for this whole enlightening journey. I think this is the point where I have to confess, I think I'll miss hearing your voice. I'm wishing the class doesn't end. And I'll just go straight to the questions so that others can have the time to ask. Yeah, so a particular factor that always interests me is the PE ratio of companies. You know, whether you see it on Bamboo or on other trading apps, the PE ratio seems to be a factor. So I want to know, is it a high determining factor in choosing a stock to invest in, or it is just one of those feel-good metrics? Is it something to really consider before making the choice of investing in a particular company when you're done researching, or you could overlook it?
All right, thank you, Mo. So I'm going to go straight to answer your question. Now, the P ratio, that's the price to earning ratio. So that is the amount of earnings. Let me get you exactly how Investopedia defines PE ratio. Then I'll go ahead and tell you what and why you need the PE ratio, when you need it, and when you might not need it at all. Now, the price to earning ratio is the ratio for valuing a company that measures its current share price relative to its earnings per share. So you're going to consider how much they have earned per share. The PE ratio relates to the company's share price to its earnings per share. So let's say, for instance, a company reports their earnings report, and they say, okay, per share, if the share is selling for $30, and they said they've earned $1 per share. So the price to earning ratio is the relationship between the company's share price and the earning per share. That's the PE ratio. Now, if you take a look at the PE ratio of some companies, a higher PE ratio signifies something. A double digit or a single digit PE ratio also signifies something. If you take a look at a company, let me pull up my Yahoo Finance, for instance. If you take a look at a company like Tesla, 1 second, Tesla. The PE ratio of Tesla is 1,055.47. Let me take another company, Microsoft. Let's check the PE ratio of Microsoft. The PE ratio of Microsoft is 34.65. Now let's compare these two companies. It simply means a higher PE ratio. It simply means people are paying a lot of money. They are pricing the share of the company so high because they believe in their mind that this company is hot, this company is great, and this company is going to be very, very great. So they are buying it and paying a premium for it in anticipation of the company's earnings growing. But for a company like Microsoft, that the company is at the double digit, 34.65 PE ratio, the translation is investors are not so desirable of the stock such that they want to pay a premium for it. People just want to pay enough for it for the result. You will understand very carefully that everybody wants Tesla. So the demand for Tesla stock is very high. So anybody that owns a Tesla stock, they are hardly selling it. And the price Tesla is selling right now is far too expensive. Tesla is overvalued. So in the next 5 to 10 years, if Tesla does not continue to report impressive profits, what's going to happen is the stock of Tesla is going to be less enticing, less interesting to investors, and then they will sell it off. But if Tesla continues to put up an impressive performance, continue to increase their revenue, their profit margin, their earnings per share, quarterly, annually, over the next couple of years, they will be able to defend that high PE ratio. So if you are looking at the PE ratio, you need to look at the figure, what it says. Then you also need to check the business, the fundamental business. You need to ask yourself, the way Tesla is today, checking their finances, their business operation, their earnings report, and where their revenue is coming from. Do you believe that in the next 1 year, in the next 2 years, in the next 3 years, Tesla will continue to be profitable in order to defend its price share? If your answer is no, then it will be better for you to run away from it. But if your answer is yes, then you have a strong conviction in the future prospect of the company, like every other person that is buying it at a high cost, then you buy it and you keep it. Let me give you an example of one stock that I own and I believe so strongly in their ability to keep earning profit and that is doing very well is Shopify. So you cannot compare the three of them together: Shopify, Microsoft, and Tesla. Now, for Shopify, the PE ratio for Shopify is 494. Shopify is also selling at a huge premium, but less is selling lesser than Tesla. Tesla is a lot more expensive. Now, expensive nature of Tesla is not by the cost of the share, because people always think if a share is selling for $5 and another is selling for $10, then the $5 share is cheaper. No. Now, a unit of Shopify is selling at 1,280. A unit of Tesla is selling for 675. But considering the PE ratio, the Tesla is more expensive. More expensive means it's overvalued. It's selling way above its intrinsic value. Selling way above what the power of the business. The power of the business is measured by its ability to earn, to generate revenue, and break into profit. In this case, the earnings per share of Shopify is $2.59. The earning per share of Microsoft is 6.71. Microsoft is an incredible business, but many people are not looking at it. So in the next 5-10 years, you will see Microsoft doing very well because they have Azure cloud service and the like. So in summary, this is how you go ahead and use the PE ratio if you must use it at all. But at some point, when you are talking about growth businesses that are in their early stages, there are a lot of people factoring their ability to grow very fast. The PE ratio might be a metric that will hold you back. The PE ratio of a company can also show you a company that is not growing very fast, that is very slow. So that's how you can use the PE ratio to complement other things when you're researching about a company. I don't know if I've been able to answer your question, Ansela.
Yes, you have. Obviously, the class is recorded, so I would listen again. And like you said,
no. The recorded class, you can find it on YouTube.
Okay.
But
So
I answered your question live so that you can have opportunity to interact with me. So I'm asking now if what I've explained to you, if it makes sense.
Yes, even before I asked you, what you said is the same feeling I had. I felt that the PE ratio could be a factor that could limit you from investing in a good company. So it is best used for comparative analysis, and also helps you to determine what to do. But it is not like a cast in stone factor, right?
Correct. That is
Yes. So I don't know, but do you think that the market cap for any stock, for any company really, is it also a good weighing factor?
okay. I'll take your question and then I'm going to go to Emeka as well. Now the market cap of a company, well, it depends on what you're looking for. Sometimes when people are looking for a high growth company, they want to look for a company that the market cap is still small, maybe like 700 million, maybe 1 billion, because they are factoring in that before that company will hit 1 billion or 2 billion or 10 billion, 1 trillion, it will 10x or it will 100x. So people are looking for growth stock. They always look at the market cap of a company. So yes, you can look at market cap if you're looking for a fast growing business. But then a company with a large market cap has more stability. But a company with a very low market cap, most time they have less stability, they are very volatile, and the risk is high. So you need to know what you're going for. Those are some of the things you can tell from the market cap of the company. Okay, now let's go to Emeka. Emeka, you have the floor.
Hello, Jess. Good evening, everyone.
Yeah, good evening.
My question is with regards EFTs. For the duration of the program, we've seen that
EFT or ETF?
ETF, sorry, ETF.
Okay.
And I've seen, there's a lot of focus on ETF, mainly because of the way it's set up and the kind of resources they have behind them in terms of number of analysts managing them. So the question is, what's different with what we have, for instance, the VOO and all these other ones, with what some banks are currently offering? And I would be specific. So a bank like Standard Chartered Bank is offering, it's under what they call a foreign currency mutual fund scheme. It's an annual return of about 8%. That's what they promise. And I can see that they are offering funds managed by Allianz, BlackRock. And I mean, if you research some of the EFTs we've been working with and some other single businesses that we've been researching on our own, you would see that this same businesses, same way Vanguard also owns some of these shares, the same BlackRock and the rest also own those same shares. I'm just trying to find a balance here. So how does what we're doing, what's the difference between what the banks are offering currently?
Okay. Thank you very much, Emeka. And I like the depth with which you have gone to further grow your knowledge, because when you relate a new knowledge to something you already know, it helps you to build a stronger knowledge base. You build a new connection. So if you have the fact sheet of the fund that Stanbic IBTC is selling to you, you will already see those information you are mentioning. The people administering the fund, like BlackRock and the like, and they will also tell you the instrument they are buying into. Are they buying bonds? What percentage is bonds? Are they buying stocks? Are they investing in US market, in Europe, in emerging market? Everything will be stated there. They're also going to state the risky nature of the investment. Maybe it is low risk, medium risk, or high risk. In addition, they will tell you the expect projected rate of return annually, and they will tell you past performance is not an indication of future return. Mm-hmm. There's one more element that investors buying into mutual fund, even US dollar denominated mutual fund, often miss out. That is called the cost, the commission, the charges that come into administering that fund. The fees are usually something we ignore. They might tell you that the cost of managing that portfolio for you, that fund, is 1.5%.
Yeah.
They will then go ahead and tell you that if it returns a certain amount, they're still going to charge another 2%. At the end of the day, by the time you check it, the fees might be close to 3% or 3.5%. Mm-hmm. Now, this fee is what we call the expense ratio. Mm. But the difference between that fund and the ETF is that fund you are buying, you can only buy it during the day. And if you want to sell it, you have to wait for another 24 hours to sell it. It's not publicly traded, so it's not very liquid. It is liquid, but not very liquid. But when you buy exchange traded fund, you can buy in the morning and sell 30 minutes later. And most of the low-cost ETF, their expense ratio are clearly stated. And these funds are also managed by companies similar to BlackRock. Vanguard is a big fund managing company. And the expense ratio is 0.03 or thereabout. Yes, for most of the low-cost ETF by Vanguard. That's all you are paying. And the fund is passively managed. There's no heavy rotation in the stocks there because it mimics the S&P 500. The last time they did some kind of reshuffling was when Tesla was added to the S&P 500. So they had to sell off some things to do some rebalancing and bring Tesla in. So if you're deciding which one to go for, these are some of the things you consider. Do you want something very liquid? Do you want to pay more? Which one pays your investment objective more? So just the same way, Stanbic IBTC US denominated fund has fact sheet. If you go to the Vanguard website, you see their fact sheet as well. Yes. Then many of these funds that you buy here in Nigeria require you to maybe have a US dollar account. Then they'll tell you maybe minimum is $1,000 or minimum is $5,000. But unlike when you can buy VO with $50 and you don't need a dollar account. So I don't know if I've answered your question.
Yes, you have. Yes, you have. Noted. Noted. So like I stated, I've already looked through the bulk of the fact sheets that they've sent. You can see the allocation of the shares in terms of top 5 holdings, the percentage going into energy, into equities, into securities. You would see the past 1, 3, and 5 year split. You also see since inception what it's returned. And also you'll see the fees. So just like you stated, the fees were something I was also worried about, because I know with what we've been doing, apart from the commission charged by the broker, there was no other fee that we were looking at. Then maybe at the point of earning investments, looking at what is applicable within the law. So this was a whole lot. It's 1.5 management fee. So for this particular fund I've been analyzing with them, the total expense ratio is about 1.56. Some other ones are a bit more expensive, tending towards 3.0, just like you just stated. So I was just trying to find out how to place them side by side, which what you just said makes a lot of sense.
Okay. All right. So, okay, Bruno, go ahead with your question.
Hi, Jesse. Sorry. So it's just something that I've been asking myself before, and I know you've already answered it in class too, I think. So I have intentions of, by His grace, traveling out of this country, and I know that with Bamboo already you can invest even if you're outside. You can continue investing as far as you have an IRA account, and you can continue funding it and then buying your stocks and monthly investing based on how you want to invest. But is it possible for us to transfer our shares to another app, like the same way we have Bamboo, so we have Trading 2-1 and the rest outside? So is it possible for us to transfer shares from one app to the other? Because if you travel out, after a while, you might not be able to continue managing your Naira account, and you want a scenario where you don't lose your shares or you are forced to sell your shares. So that's the question I have.
All right, thank you very much, Bruno. That's a very valid question. Just like as I said when I started, I said, you invest like yourself. I will invest like Jesse. There's no need for comparison. There's no need to try to do better than the other person. You see, Bruno is thinking of possibly moving out. And maybe you, in your own case, you probably want to settle and live in Nigeria. So it's different. Now, this is something I have not explored with the brokers here in Nigeria. The best way for you to get this answer is to speak to your broker. It is possible to move shares without selling it from one broker to the other. When Robinhood was making a mess during the GME and GameStop and AMC saga, stopping people from being able to sell their shares or buy shares, quite a number of people moved from Robinhood to other brokers. All they had to do was write a letter. Some of them have a fee for moving it, but yes, it's possible for you to move it because the shares are in your name. They are not held in custody. You have a register with the Security and Exchange Commission that shows that Bruno has so amount of shares with Apple, so amount of shares in VOO. So moving is always possible. However, you need to check with your broker and write to them and ask, how do they do it? Is it possible? What are the charges? You need to let them know. So, and it will be
that's
good
fine.
for
That's
you.
fine. Yeah.
It
Yeah.
will be good
Thanks.
for you to let them know now before you grow too far.
That's very true. That's very true.
Yes.
Thank you very much.
You're welcome. So, okay. If there are no more questions, will this be an appropriate time for me to conclude?
Hello.
If you can
Hello.
use the raise your hand feature. You have a question, Fortis?
That's exactly a question.
Go ahead.
Yeah. So first off, thank you very, very much for this platform. I've learned a lot and I came in through the giveaway pathway and I've learned a lot, a whole lot. So I just want to thank you. Thank you very, very much. Thank you very, very much.
You're welcome, Fortis. It will make me I will be a happier person if you actually go ahead and practice the things you have learned, because the real value from this is in the doing. You only get better.
Yeah. Yes. I started off like 2 weeks before I got into the class. So there were some things like until I observed about the stock market, attention to details is very, very important. The little things, as much as waiting for 10 minutes, as much as waiting till sometimes 7 p.m. before you make some decisions, as much as trying to read one extra article. You get what I'm saying, sir? So I learned those stuff within the class. So after this, what I did was I have a portfolio. So that portfolio, I made it like a semi-short term stuff, something like 6 months, 1 year portfolio. I'll just trade, sell and buy. So then after this class, I created a retirement portfolio for like with ETF, primarily ETFs, and I added an AKK ETF to it. So that's doing steadily well. That's how just opposing it. Thank you.
All right, keep growing. All right, Adeola, you have not said anything.
Yes. Hi, Jesse. Hi, everyone. I think the other participants have said it all. I've been taking notes. The questions have been very comprehensive. So at this point, I don't have anything more to add. Just, taking notes as you guys all talk. Thanks very much.
Okay, I have a question for you. In the last 1 week to 2 weeks, what would you say about your experience in the market? How you feel about your investment, the lessons you have learned, 1 or 2 things you want to be able to do better as you go ahead in the future?
To be honest, I'm yet to actually go into the practical side. I have not, and sorry about that. Well, I was down with COVID and a lot of other things. So I fell behind. But this week, I'm looking to actually do all of that. So sorry, I don't have much to share on the experience side.
Glad to have you strong and back on your feet again. Okay?
Thank you.
Health is wealth. So thank you all. I regard everyone as a family. And first and foremost, okay, Imo, you still have 1 more question. Now I'm going to send you an invoice for this question you want to ask. Imo, go ahead.
Just one is an honest confession, and then I think 2 are just minimal questions. So just about the metrics I see on brokerage apps, I really tried to study this on my own so that I don't have to bug you, but I really want to understand what maybe determines a company paying a higher or lesser dividend per yield, and how does that work? what determines them paying it in the first place? The second question would be not really a question, but before getting onto the class, I used rice vest and also bamboo before starting the class. So now I am forced to diversify my funds, the funds I put in monthly across these two apps. So, and I know that it will, without my income pipe being increased in right now, it will in a way affect the percentage that goes into this. And all of the portfolios, all of them are all stocks. What do you advise I do? Let's say 50-50. What do you advise I continue doing with respect to the fact that the funds I put in monthly are static or maybe a bit higher? And number three,
No, let's take it so that I don't forget. Let's take it one after the other.
No, it's not a
I'll ask
question.
you. Okay.
Yes, it's just a request. I had told you that I was down. I was a bit down health-wise, and I couldn't finish up with the assignment you gave, which give someone a chance to get into the exclusive club. So I want to know if that slot is still open for me, because I was almost done with it. I was done with one company, but you asked for two.
The one you are done, you can still send it. I'm still grading all the people that send their question in. Yeah, so once you're done, glad you're back and you're doing well now, you can send it in. Secondly, you asked about what decides how much a company shares out in dividend yield. It is determined by the executive of the company and the board of directors. So they decide it in votes because it's a decision that can determine how the business grows. So they either decide to give the dividend or to reinvest the dividend in ensuring that the business grows. Because what's the value if they share the dividend? It's just like if you are growing your business, you're growing your company. And at some point, in the early stages of building your company, when you make profit, do you take the profit and spend it, or do you reinvest the profit in the business? You most likely reinvest the profit in the business so that the business can grow very fast. So many times when businesses declare profit, they sometimes decide that, okay, let's just share little of the profit and reinvest the rest to make the business grow. And sometimes they share these dividends to make the investors happy because they know some investors like dividends. So the dividend play varies from company to company. Amazon doesn't pay dividends, but Apple pays dividends. Microsoft pays dividends. Apple wasn't paying dividends in the past, but they are now paying. And in fact, then to your question about, what was the other question you asked? There was a third question you asked.
My portfolio around the apps I had always been using before I got into the class, and how the earnings will be affected.
Yeah, I can advise you on that publicly here and now. If you want to answer to that, you probably have to consult with me personally. 1 hour is 20,000 naira. That's portfolio balancing. It has to take into consideration a lot of things: your income, your investment objective, and then the allocation will be done accordingly. Getting stocks in rice vest and getting stock in bamboo, you are doing the same and the same, all and well, the same. Whereas rice vest has fixed income opportunities that you can use to diversify and spread your risk from the risk and volatility of the stock market to a more stable investment, which is slow in growing, but is stable, to balance things up. So there's a way that you can do it, and I can suggest to you if you do come to consult with me.
All right, thank you.
Yes. Okay, good. Thank you so much for the many engaging questions. I've enjoyed answering them, and it shows that we are all going to do something about our investing journey. This is how we come to the end of this class. But this should not be the end of your investing learning journey. I will encourage you to try and get a couple of the books I listed in the top 10 books you can read as a retail investor. Number one among them is The Psychology of Money. The Dando Investor is also a very great book. I enjoyed reading it as well. Then you should also look at great tools on YouTube, Investopedia, Yahoo Finance to continue your learning. Additional way you can learn is by joining a community of like-minded people that are investing. You can find anyone along the internet to join, but if you're interested in joining mine, it is available. For 40,000 Naira per year, you can register to be in my investment club, where we teach once in a month. We have a forum like this. Topics being discussed ranges from discussing different asset categories, real estate, bonds, stock market, cryptocurrency, agri crowdfunding, or venture investing, as well as talking about analysis of how the market is and sharing in investment opportunities that I am going into, or materials that I've seen or discovered across the web that is useful for me. I share it in that space. And then you can also see and hear how other people are going about their investment journey. It's a journey, it's not a sprint. So working along with other people can help you to be able to enjoy the journey with other people. So this is how we come to the end of the class. The cost for 6 months is 25,000. The cost for a year is 40,000. So it is renewable. In the future, I'm planning to set up a class to teach only cryptocurrency. The March class that I started yesterday has crypto in their module. They are paying 20,000 Naira for their own class. So, but I'm planning to have a crypto class only very soon, but the module is not ready yet. For you to be able to find out, please do well to be following me on Twitter, for I will announce it when that course is ready. If you have not invested anything at all, I encourage you to go ahead and please invest. If you are always afraid and you stay by the roadside, what's going to happen is you might look back 6 months, 1 year from now and wish you had started today. Nobody starts anything just because they are comfortable at it. Growth means we keep going out every day to do what makes us uncomfortable. That is how we grow. Like I often say, do the things you fear. That is how magic happens. Thank you very much for trusting me and registering for my course. And I'm sure I've been able to deliver value to you. About doing the things you fear, this is the very first time I'm hosting a Zoom call from a premium account. I paid for it today and I'm live streaming it on YouTube. I've never done it before. No one has ever taught me, but now I have done it. Now I'm no longer afraid of it. So I encourage you to do the things you fear so that you can create magic. Thank you and have a wonderful evening. Bye for now, guys.
Bye. Thank you, Jesse.
Bye.
Yeah, bye.
Thank you.
Yeah, bye.
Thank you, Jesse. Bye.
Bye.
Bye, Jesse.
Bye.
Au revoir.